After we saw so far so many new and exciting capabilities about our platform, which for example Jan presented, how we do stand up to transparency, I will now shift away the focus from these auxiliary services, I call them the soft skills of the structured products, more away to the core of the product itself. I want to present our innovations in the space of structured product space, the products itself, and especially in this presentation about the available wrappers, the format, the investment vehicle which the client ultimately invests his money into. And so I think this fits very nicely with what Professor Janssen just said about the counterparty risk, because this is a major issue at the time. And this initiative Lucas talks about should really address this issue from an investor perspective and also from our view. The starting point of my presentation will again be the values of our firm, because these values define what tools, what products we do want to offer to our clients. Before then going into the subject of exchange-traded structured funds and actively managed derivative funds, I will first talk about the evolution of structured investments, because I think this will make it very clear why we do think there is a need for this new format to make structured derivative investments available to clients. As I said, based on our values, we define the services we do provide to clients. We want to offer them. And about that, we already learned quite big a deal. But I think if we really want to stand up to transparency, it's not only important to make the products itself more transparent, but also based on that to expand the range of products offered. Because what does transparency mean? More transparency leads to more differentiability. This means when products become more transparent, two products which before seemed for an investor to be the same with added transparency, suddenly they are different. This means this will lead to new demand for new products, and we want to fill this gap which come from the expanded transparency, and we are committed to offer this product, to offer the investor a full range of available products so that he is able to manage all his risks. Because as I said, the challenge is to broaden the product palette as more transparency leads to a new need of demand from the investor side. But before presenting now the key facts about exchange-traded structured funds, let me quickly have a look at the evolution of structured investments so far, because it will make clear why we need these kind of structures, especially in the current market environment. When talking about the evolution of structured products, it's always good to see it in a bigger picture. Structuring a product is always the content. This means the underlying you do want to invest in. Talking about the structure, this means the certain payoff you put on top of the underlying. And also the wrapper, the investment vehicle the client puts his money into. Recent years have brought dramatic evolution in terms of underlyings, in terms of structures. I mean, nowadays it's possible for an investor to get access to almost any underlying. One good example is, for example, commodities. Some years ago for retail investors it wasn't merely possible to access these markets, but nowadays you can invest nearly in all commodities as exotic as emissions, for example. There are also a whole bunch of strategies out there which are available basically to anybody. And I think we saw the same evolution on the side of the structures. This means the available payoffs to clients. We saw a tremendous evolution there, and nowadays almost any payoff, as exotic as it could be, is now available. And I think this trend was mainly driven by the need from the investor side to manage their specific risks based on their own utility function and their preferences and needs. Because as we just learned before, every investor is different and has different needs. But I think, especially in the structured products segment of the market, some risks weren't really addressed. This has been reflected in a lack of innovation in the wrapper. The third part, as I said, we have underlying structure where we saw great evolution, and the wrapper. But there we didn't see a whole lot of evolution. And the risks we're talking about are counterparty risks, liquidity risk, and transparency risks. We already learned how we tackle, for example, liquidity risk by our commitment to list the products and provide a liquid secondary market even in these times of crisis. How we want to add transparency by making the details, the features of the product understandable to the clients. But we also want to talk about counterparty risk. And there comes this slide into play. Because we think we need to offer new solutions in order that the client has the possibility to really address the counterparty risk. So we want to expand away from the well-known note format, which is nowadays almost exclusively used for structured products, away to exchange-traded structured funds and actively managed derivative funds. So on the left-hand side, the red box, we see the traditional format, the structured note. It is highly flexible. You can mirror almost any payoff. There are almost no limits in terms of underlying, in terms of leverage, in terms of structure. But still, it is an instrument which is bearing issue risk and is unregulated. So we want to move away to the right-hand side, to the two blue boxes, where we are in the space of segregated assets and which are regulated, government regulated, and offer the ETSF, which is almost similar in terms of content, underlying and structure to the traditional structured products, and also actively managed derivative funds. Because we think this addresses the need of many investors to manage really all the risk, and not just underlying risk, that he wants to get exposure to certain asset classes. But, as I said, risks such as transparency risk and counterparty risk. As I just mentioned, ETSFs and structured notes have many similarities. In fact, underlying and structure can almost be the same in a structured product, in a note format, and in an ETSF. Both have a static structure and a dynamic risk profile. This is something Jan already talked about this morning. So we can think about that, for example, like you have the sun, you're losing a lens to focus the beam of the sun on a certain spot. In a traditional structured product, you put the lens in a place, leave it there. At the beginning, you have your nice focus on the certain point you want, but the sun is moving. This means also the outcome where the focus of the lens is. This is exactly what we have. The lens is fixed, so a static structure, but the outcome, your risk, is dynamic. One good example is for maybe a reverse convertible. Say you invested into one of these 2 years ago when markets were calm. At that point of time, it behaved more or less like a fixed income instrument. You were almost certain to get your money back. You had your safe coupon. But markets are changing. And when markets plunged, these kind of instruments suddenly behaved like an equity instrument. It wasn't anymore that interest rates really drove these kind of products, but suddenly it was volatility and underlying equity risk. So that's what we really have in these kind of products. Your risk in the end is changing every day. So as said, in terms of content and structures, there are almost no differences between a structured note and an ETSF in terms of what you can do. There are some limits in an ETSF because due to the UCITS-free regulation, there are some constraints in terms of the underlying to use and the amount of leverage. But the key difference between these two instruments is really that an ETSF is a fully segregated asset. Just to make the point clear, unlike in a structured note, you don't have basically a deposit in a bank where the bank guarantees you your product, but you have a fully segregated fund format. So the next slide, I think, is about the evolution of transparency, the evolution of service, and I really much like it. Because when talking about structuring a product, it's not always about the core of the product, content, structure, and wrapper, but also of the services we build around that. So there's also the question how we do bring these features, how we do present the client the features of his product. So it's about transparency and service, where we want to make available as much information as possible through our constructor, through dynamic term sheets, and through irregular reporting. Because until very recently, so now on the left-hand side, there were normally only prices for structured products available, and even that just on a one-off basis. I mean, even myself can remember times when it was like once a week evaluation went out to clients, which is actually kind of strange. I mean, because there are models to price these things when you trade them, and these models are still around when the product is done and when it's you can trade in the secondary market. So why shouldn't it be able to have ongoing price information? This changed somewhat when the issuing investment banks started to list these kind of products on the exchanges and commit to secondary market. Then you had the market making, you had price transparency. But still, I mean, that's not full transparency. The next step is then to add a regular reporting where you have a risk monitoring, where you see the drivers of your product and also the dynamic term sheets I just mentioned. But still, we want to take it one step further from there and introduce, by using the fund format, full price transparency by the use of an independent custodian for daily valuations and an additional layer of safety through the regulations. Because this format is government regulated, you have external audits and the risk is controlled by the custodian. So basically, in our view, an ETSF offers two main advantages. Unlike in a structured note, the counterparty risk can be, depending on the investment you have in the fund, almost wholly mitigated. You don't have anymore 100% counterparty risk to a certain financial issuer. And the second thing is to get way more transparency and more security through the regulated format of a UCITS-free fund. So this means now, as you see here, we move away from the structured note format into the segregated asset space. Now, even as content and structure can be quite the same, there are some differences. First, because the assets in an ETSF are fully segregated, the investor faces a much lower and different counterparty risk profile than in a traditional note format. But as you could expect, structured note is more flexible, as you can almost meet any specific needs, and there are hardly any restrictions in terms of instruments and leverage which you can use. Whereas an ETSF has, due to its regulatory nature, certainly some restrictions in that space. And also, structured note is way more flexible in terms of time to market. Nowadays, it's possible to get it issued and listed almost within one single day. Whereas, as you could expect, an ETSF takes a little bit longer because it's a new body which will be set up. So we're expecting there normally a launch within 2 to 3 weeks, which then you also can see on the cost side. As we already learned, it's possible to issue structured products nowadays with a minimum size of as low as 50,000 Swiss francs. Whereas due to the cost, the setup cost, the ongoing management costs, and the costs for which bring the custodian and so on with it, the minimum size for exchange-traded fund is remarkably higher. But the main point is, it's not about which one of these two formats is better. It's about enhancing the tools which are available to investors, because we want to offer them the choice what they want. I mean, if it's for an investor more important to have a flexible, highly flexible note, to have it really fast at really low cost, then maybe the structured note is the right thing. If an investor seeks the safety of segregated asset, then we can deliver basically the same investment in a fund format to really address his needs. I think one good example for this point is, imagine now an institution which had, for example, made an investment in commodity in a note format. He's fine, he has his asset allocation, even that markets plunge now, he keeps to that because he has a long-term view, but suddenly he finds out because the institution which issued this note is doubted to have some problems. This means now that this note doesn't really behave like a commodity investment anymore, but more or less than a fixed income investment. And that wasn't certainly the goal when he entered that product. So we want to offer our clients the possibility to choose what they really need. So the next step is I want to take you through an example of such an ETSF to make it clear where are the similarities to normal structured notes and where are the differences. Just one disclaimer, we will be in the near future involved in the structuring of such funds or be an advisor, asset manager or distributor. We are just waiting for the approval for our change of purpose. So this example I take you through is now a hypothetical example, something we could talk about. And just for this case, we take the assumption that we would launch this kind of product together with former Futura, a long-standing partner of ours. So as in any structured derivative investment, the first step is now to define the content, the underlying. This would be done now in cooperation with former Futura, who would select a basket of Swiss stocks which meet certain criteria. In this case now, these are three criteria to select sustainably managed companies. Criteria are assessment of management quality and performance, environmental impact assessment, and the social impact assessment. This gives you basically the base investment universe. After performing a financial analysis on this base universe, you would then select a basket, which in the end is the underlying of a product, which we can see now on the right-hand side. The second step is to choose then an appropriate structure for the product. As we want to show you the differences of an ETSF and a structured note in terms of capital protection, we go for a capital protected note with a bonus coupon feature where the investor has 7 chances for a 3% coupon each semi-annual, because the product has a tenor of 3.5 years. And we chose this structure because we also believe it really makes sense at this point of time to lock in maybe not the lowest value of markets, but pretty attractive levels of markets. So far, there hasn't been any difference to a traditional structured note in terms of the process, what we did. We selected the underlying, and we selected a structure which we think is appropriate. But the main difference now between the structured note and the ETSF comes now when we are analyzing the bond component. Instead of holding a liability in a financial institution, where the institution basically in the end says, yes, I guarantee your capital protection at maturity, the investor now holds basically interest in a fund. And the capital guarantee in the fund is, as I said, not achieved by the issuing financial institutions, but by selecting high-quality, low-risk bonds, such in this example now Swiss government bonds, which makes somehow sense that because on the one hand side, where the Swiss government is deemed to be one of the best credits actually, and the product itself is denominated in Swiss francs. So this limits counterparty risk substantially and gives the product the highest possible credit quality. Because now your counterparty is the Swiss government and not a financial institution anymore. So, but as in any UCITS-free fund, there are some constraints in respect to the instruments, to the assets the fund can hold. And we can see that on that slide. Instead of holding just one bond to achieve the capital guarantee at maturity, we are now invested in 6 issues of the Swiss government due to the restrictions. And the goal is just to select a portfolio of bonds to achieve a duration which is as close as possible to the maturity of the product itself. When putting this presentation together, I saw this slide and asked myself, does it make sense to have this slide in here? Because it shows you the payoff of the bonus coupon structure. On the one hand side, this structure isn't actually brand new. On the other hand side, it isn't really the subject of this presentation. However, it makes an important point. Up to now, when the investors see this, maybe two different products, but from two different issuers with the same payoff, he thinks, well, that's the same. And this is how it has been during the last year. You had an underlying, you had the same structure, and then you just went for the price. But this is also what we think about transparency. We want to make all the features transparent. And when everything is transparent, so I refer now to the last slide where we see how the capital guarantee is achieved, then we really see that this product in an ETSF and in a structured note is something totally different. Because the one is guaranteed by a financial institution, and this one here, you have as a counterparty basically the Swiss government, because the guarantee is achieved by Swiss government bonds. And this is what we want to achieve. Through transparency, we want to make sure that the client really gets what he sees. But again, let me stress that to you. Just because the payoff seems to be the same, there can be other features in a product which can lead to a totally different risk profile, although underlying and structure are somewhat similar. So the second structure I want to talk about is now the actively managed derivative fund, where we move further away from the structured note and from the ETSF to a product which has a dynamic structure and a static risk. So if I can recall the example with the sun and the lens, this means now the lens isn't fixed, but we are actually holding the lens in our hands and move it in a way that the sun is always focusing on exactly the same spot. So what we want to achieve is a certain amount of risk through adjusting the structure, which is actually the opposite as in a structured note. We have now the structure dynamic, with a goal of keeping the risk static. Each structured product, or put it differently, each derivative payoff has its own characteristics now on this graph in terms of market expectations and the risks you're taking. So as expected, we can see on the right-hand side call and put options which are quite aggressive in terms of market view and risk. We have other well-known structures like the capital protected notes for a bullish and a bearish view. And I think the main message of this is now that it's possible with asymmetric payoffs to mirror almost any market expectations, any need in terms of risk an investor wants to take or he wants to not to take. We can build that with different derivative solutions. But as already mentioned, the risks of such an investment is changing during the lifetime of the product. And now the different approach is to take not the structure as given, but to take the risk somehow as given, and to manage the structure in a way that we achieve that. And this is exactly what we do want to offer in an actively managed derivative fund. So as a base case, for an example, we take now a certain payoff. This is now a capped bonus certificate where you receive a bonus as long as a certain level, as long as the underlying doesn't drop below a certain level. It is basically for sideways trending markets. And you also have an upside which is capped. This will serve now as a base case of our hypothetical funds. So normally we would be invested in a portfolio of underlying equities or equity indices And the addition of derivatives to this portfolio enables to generate, in this case now, a return in sideways trending markets. I have here the composition of this payoff. Why do we have it in here? I mean, we have the zero strike call, short call with a strike where the payoff is capped, plus a long down and output. The reason why I show this to you is we can decompose these derivative payoffs into its elements, and even the long down and output can be replicated by using simple plain vanilla options. And the idea behind that, if you have such a fund, you don't want to go every time you rebalance your portfolio to an investment bank and ask for these kind of structures, because then again, you have counterparty risk. And so where is the point in setting up the fund? No, if you can decompose it into plain vanilla options, you have highly liquid, exchange-traded options for that purpose. So in a way, we take this base case of a structure, decompose it, and then we have the possibility to using exchange-listed instruments and to therefore totally mitigate the counterparty risk. And then again, the fund format makes highly sense. So we have now the base case, which I already talked about, but based on that, we can go further and manage further risk the client wants to take. If you, for example, need some more safety, we could, in this case now, add a very deep out-of-the-money put, where you hold a long position in it to achieve further safety if markets will plunge. And just to give you an idea that this just serves as a guideline, and on top of that, we could basically mirror any risk profile. And I think this graph really helps to understand what we want to achieve in this kind of product. We want to have that merely as a goal. This means this portfolio is adjusted from time to time depending on what the market is doing, because as we found out, the structure might be suitable at the initial of the product, but not during the life as markets are changing. So what we want to achieve is, as markets are moving, to get the structure back there where we want to have it in order to have the focus of the lens on the certain point again. So on the last slide of my presentation, this is now a possible matrix in terms of market expectation and absolute risk. These buckets represent certain products depending on your market view and the amount of risk you want to take. And the idea is now basically to offer for each bucket a certain fund in order that the client has the possibility basically to choose the amount of risk he wants to take. So this is what I wanted to present you about our new formats, about exchange-traded structured funds and the actively managed fund. And I think the key message here is what we want to achieve. On the one hand side, through transparency, that the client really sees all the risks he's facing, and on the other hand side, offer him, in terms of underlying, in terms of structure, and in terms of wrappers, all the tools he needs that really he is able to manage these kind of risks.